The S&P is the largest and most liquid market for insurance in the world, making it the most over-demanded index historically. Many flows from institutional hedging and structured products buy options on the S&P on a monthly basis. One of the largest flows from institutions includes the buying of puts to protect their long equity exposure and selling of calls, covered calls, to funders. This increase in out-of-the-money put buying drives up the implied volatility on lower strikes, and conversely, the selling of out-of-the-money calls drives down the implied volatility on higher strikes. This monthly inflow of options transactions leads to what is known as the Index Skew, which is a carry trade to ensure protection on long assets. Although not the only factor driving the S&P, delta hedging of the Index Skew is large enough to influence the S&P and occurs reliably each month. The Index Skew leaves market makers long out-of-the-money calls and short out-of-the-money puts. For clarity, we will merge the P&L profiles for both positions into a single curve. The probability of price distributions for the out-of-the-money calls and out-of-the-money puts are shown above and below respectively. Since the implied volatility is higher for the out-of-the-money puts, the probability of price distributions has a larger variance for the puts. For clarity, we will represent just one half of each distribution, showing the price distribution for the out-of-the-money puts on the left side and the price distribution for the out-of-the-money calls on the right side. Market makers must first hedge both positions by being short. The size of these short hedges is proportional to the probability that these options go in the money, represented by the blue shaded area that is in the money. Most liquidity in the S&P options are in the first 3 months, with the majority of open interest concentrated at the near-term monthly expiration. As this open interest gets closer to expiration, within a week or so, the effects of market makers delta hedging Vanna, charm, and gamma exposures on the Index Skew become particularly noticeable around this time. These delta hedging activities typically occur close to the open and close of trading hours, as time is taken out of the models of banks and market makers. In most scenarios, the delta hedging of these exposures begins a cycle of self-reinforcing buying. This begins with the passing of time, which means that the probability of price distributions narrows. This causes market makers to delta hedge their charm exposure by covering some of their short hedges. Passing of time can also cause implied volatility to decrease when the term structure is in contango. Implied volatility slides down the term structure as time passes. Naturally, the decreases in implied volatility are more dramatic the steeper the contango. Thus, passing of time also helps to reduce implied volatility, further narrowing price distribution probabilities and requiring market makers to further cover their short hedges. This helps to push the S&P higher in price as these options approach expiry. These increases in price help push and maintain the market makers towards being long gamma and thus maintain mean reversion in the market. Although the short put position does impart a negative gamma, this is overwhelmed by the positive gamma from the long out-of-the-money calls, which is due to the higher implied volatility on the out-of-the-money puts, which reduces their gamma exposure in comparison to the out-of-the-money calls. The combination of these factors helps to push the price of the S&P up in a steady and non-volatile manner. The reduction in unrealized volatility also helps to reduce implied volatility even further, which again must be delta hedged by buying. This feeds on itself in a reflexive cycle, causing the S&P to grind up higher in price as these options approach expiry. The net effect is that in most normal markets, the effect that the Index Skew and the delta hedging of it has, when combined, is to help create a market where the S&P slowly grinds up in price as these options get closer to expiry. Once expiry does occur, these effects are temporarily taken out of the market as structural and institutional inflows once again start to come in and repeat the cycle. This pattern, however, can occasionally break in certain situations. In most situations, if implied volatility were to increase, although this requires market makers to delta hedge this by increasing their shorts, the long gamma means that any decrease in price is counteracted somewhat by the delta hedging of gamma exposures. However, if price movements occur fast enough such that market makers are not able to roll their positions fast enough, this can manage to push the S&P to sufficiently low enough prices where the effects of negative gamma begin to take over, leading to more accelerated downward movements in price. This increase in realized volatility helps to raise implied volatility, which market makers must delta hedge by selling even more. The effect can become exacerbated when the term structure goes into backwardation, meaning that the passing of time leads to increased implied volatility. Overall, this can lead to a self-reinforcing loop where selling begets more selling through the delta hedging of negative gamma and Vanna exposures. However, as with the previous scenario, once options expire, this vicious cycle can eventually come to a halt. Thus, in summary, as options approach expiry, if fast enough downward movements in price can push market makers into negative gamma and raise implied volatility, this can set off a reflexive wave of selling. By no means is the index skew the only factor that drives market maker delta hedging on the S&P. Full modeling requires data on all the types of options transacted, their strikes, respective implied volatilities, moneynesses, and expirations. However, the index skew is regularly occurring and large enough such that the delta hedging of it helps to create repeatable monthly behavior on the S&P, which can be taken advantage of by investors.